Three tankers are moving slowly through a narrow stretch of water in the Middle East. Each one is carrying millions of barrels of crude oil. The journey they are making might look ordinary, almost routine. Ships pass through here every day. But what most people don't realize is that this thin strip of water quietly controls the heartbeat of the global economy. If this route suddenly closed, even for a few days, the shock would not stay in the Middle East. It would travel across the entire planet. Fuel prices would surge overnight, stock markets would panic, governments would scramble for emergency supplies, airlines would raise ticket prices, food costs would rise. And millions of people, thousands of miles away from this place, would suddenly feel the impact in their daily lives. This narrow waterway is known as the Strait of Hormuz, and it may be one of the most important choke points in the global energy system. To understand why this place matters so much, imagine a giant pipeline that supplies oil to much of the world. Now imagine that pipeline suddenly being shut off. That is essentially what closing this strait would mean. The Strait of Hormuz sits between Iran on one side and the United Arab Emirates and Oman on the other. At its narrowest point, the shipping channel used by massive oil tankers is only a few kilometers wide. Yet through this narrow passage flows roughly a fifth of the world's oil supply. Every single day, enormous tankers carry crude oil from major producers like Saudi Arabia, Iraq, Kuwait, and the UAE. These shipments move toward Asia, Europe, and other global markets. China, Japan, South Korea, India, and many European nations depend heavily on these routes. If those tankers cannot pass through, the supply chain begins to break. And when oil supply tightens, prices react instantly. Energy markets are extremely sensitive to risk. Even the possibility that this strait could be disrupted is enough to push oil prices higher. Traders watch the region closely because they understand how fragile this route really is. A single geopolitical escalation, a naval confrontation, a military blockade. Even threats alone can create panic in global markets. But what would actually happen if the strait closed completely? The first impact would be immediate. Oil prices would spike. Energy traders would rush to secure supplies before shortages develop. Oil futures would surge as buyers compete for limited barrels. Historically, whenever the Middle East faces serious tension, oil prices react quickly, but closing the Strait of Hormuz would be far more dramatic than ordinary geopolitical tension. It would remove millions of barrels per day from global supply. Some analysts estimate that nearly 20% of the world's petroleum trade passes through this route. Losing that much supply overnight would create one of the biggest energy shocks in modern history. But oil prices are only the beginning. Once oil becomes expensive, everything else begins to change. Transportation costs rise first. Trucks, ships, and airplanes all depend heavily on fuel. When fuel prices climb, moving goods becomes more expensive. Companies then pass those costs on to consumers. Food prices increase because farming equipment runs on fuel and food must be transported long distances. Airline tickets become more expensive as jet fuel costs surge. Manufacturing costs rise because factories depend on energy. This ripple effect spreads through every corner of the economy. Within weeks, inflation begins rising across multiple countries. For many governments, this becomes a serious problem. Central banks often fight inflation by raising interest rates, but higher interest rates can slow economic growth. Businesses borrow less, consumers spend less, investments shrink. So suddenly the world faces a difficult balancing act. Higher oil prices push inflation upward, while higher interest rates threaten economic slowdown. This is why energy shocks have historically triggered global recessions. But there's another layer to the story that makes the Strait of Hormuz even more sensitive. It's not just about oil, it's also about perception and financial markets. Investors hate uncertainty. When a critical energy route is threatened, financial markets respond immediately. Stock indexes can drop as investors move their money into safer assets. Oil companies, however, often benefit from rising prices. Their revenues increase dramatically when crude prices surge. Defense companies can also see rising demand as governments boost military spending during geopolitical crises. Meanwhile, industries that depend heavily on fuel, airlines, shipping companies, logistics firms often suffer major financial pressure. The financial consequences spread across multiple sectors. Airlines may cut routes or raise fares sharply. Shipping costs for global trade increase. Businesses that rely on imported materials face higher expenses. And because energy touches almost every industry, the economic shock rarely stays contained. To understand the scale of potential disruption, it helps to remember how interconnected modern supply chains have become. A smartphone assembled in Asia might contain materials from Africa, chips designed in the United States, and components manufactured in multiple countries. Those parts travel across oceans on cargo ships that burn massive amounts of fuel. When energy prices surge, the entire network becomes more expensive to operate. This is why energy security is such a major concern for governments. Many countries have tried to reduce their vulnerability by building strategic petroleum reserves, massive stockpiles of oil stored for emergencies. The United States, China, Japan, and several European nations maintain these reserves precisely for situations like this. If a sudden supply disruption occurs, governments can release oil from these reserves to stabilize markets temporarily. But reserves are only a short-term solution. They can slow down the shock, but they cannot replace long-term supply if the strait remains closed. Some oil producers have also invested in alternative export routes. Pipelines that bypass the Strait of Hormuz exist in certain regions. For example, some Gulf countries can transport oil through pipelines to ports outside the strait. However, these alternatives cannot fully replace the enormous daily volume that normally passes through the shipping lane, which means a complete closure would still create a major supply gap. Another factor to consider is how quickly global markets react. Modern financial markets move at incredible speed. Algorithms and trading systems respond to news within seconds. If credible reports suggested the Strait of Hormuz had been blocked, oil prices could jump dramatically within hours. Investors would rush toward commodities like oil and gold, while stock markets might experience sharp volatility. Currency markets would also react. Countries heavily dependent on imported energy could see their currencies weaken as trade deficits expand. Energy exporting nations might benefit from higher prices, while energy importing countries face greater economic pressure. This imbalance can reshape global financial flows. Some economies may gain temporary windfalls, others struggle with rising costs. For ordinary people, the consequences appear in simple but painful ways. Fuel stations raise prices, electricity bills increase in certain regions, transportation becomes more expensive. Even grocery bills can climb because food production and distribution depend heavily on energy. What makes this situation particularly sensitive is that the Strait of Hormuz has been a geopolitical flashpoint for decades. Its location places it at the center of strategic competition, regional tensions, and global energy dependence. Naval forces from multiple countries patrol the region to ensure the flow of commerce remains uninterrupted. Because everyone understands what is at stake. Keeping this route open is not just about shipping oil, it's about maintaining stability in the global economy. And yet, the possibility of disruption is never completely removed. Geopolitical tensions can escalate quickly. Miscalculations can occur, military confrontations can spiral. Even temporary disruptions, lasting days or weeks, can create enormous economic shockwaves. That is why analysts and policymakers constantly monitor the region. Energy markets watch tanker movements. Intelligence agencies track military activity. Governments maintain contingency plans, because if this narrow corridor ever shuts down, the consequences would travel far beyond the Middle East. They would ripple across continents, markets, industries, and households. A single choke point in the global energy system has the power to influence inflation, financial markets, political decisions, and economic stability worldwide. And that is the hidden reality behind this quiet stretch of water. Most people may never see it in person. They may never watch the giant tankers slowly navigating its narrow lanes, but their daily lives are connected to it in ways they rarely notice. Because when energy flows smoothly through the Strait of Hormuz, the global economy keeps moving, and when that flow is threatened, the entire world feels the shock.